Welcome back, friends, to another episode of AP Daily Live. I'm Jen Rayfields. I'm an AP Economics teacher at Ridgewood High School in Ridgewood, New Jersey. And I'm so happy that you're with us tonight for the second AP Macroeconomics AP Daily Live review session. Let's take a look at what's on tap for this session. There are four big ideas spiraled in across all of the AP macroeconomics course, and they're economic measurement, markets, economic models, the models we use to illustrate those markets, and then macroeconomic policies. So in today's session, we're focused in on economic measurement. We're going to see where it shows up in several different units. In our next session, we're going to be taking a very close look at markets and in the macroeconomic models that we use to illustrate them. In our sessions 4, 5, and 6, that's where we're going to be focusing in on policy. So session 4, we're going to be taking a look at the banking system, the financial sector, monetary policy. Session 5, loanable funds market, fiscal policies. And then in session 6, we're going to be taking a careful look at economic growth. What is economic growth? How do we measure it? How do we model it? And what are the policies that can both promote it and hinder it? So these four big ideas are going to be the subject of our next several review sessions. So let's take a look at what economic measurement means. I pulled this out of the AP Macro course and exam description, and you can read it. It says, economists construct measurements to monitor the state of an economy and to evaluate its performance over time. Governments, firms, and citizens often use these measurements to help inform policy, business, and personal decisions. So as you know, we measure a lot of different things in this course, and with measurement comes calculation. So tonight's session is really going to be focusing in on the different calculations, the different formulas that you need to know. But I think if you keep in mind what it is you're trying to measure, it will really help you with those formulas and those calculations. So we're going to be visiting Unit 2, Economic Indicators in the Business Cycle, GDP, unemployment, inflation. Those are our big three indicators of macroeconomic health. We're going to spend a little bit of time in the financial sector talking about how we measure monetary aggregates. So we'll take a look at that. In Unit 5, we're going to learn a tool for measuring the government budget balance. And then we'll come into Unit 6 and we're going to use that same tool to see how we can measure the balance of payments. So that is what is on tap for tonight. I want to review real quick the skills that we looked at in our last session. Remember that economists use economic concepts, principles, and models in order to describe, predict, and explain economic behavior and phenomena. In order to do that, we have skill category 1, which is the language and tools of economic analysis. Remember, we looked at skill categories 2 and 3 together. Interpretation, manipulation. What we're really talking about is cause and effect. Given an outcome, can we explain what caused that outcome to occur? Given a cause, can we predict what the effects will be? In our fourth skill, we're focused in on graphing. That's using these models to describe, predict, and explain what has happened, what will happen, and showing that we know how these tools work. All right, so again, knowing what you're being asked to do is a big part of answering the question correctly. What I've created here is a graphic organizer that allows you to see how these different calculate skills might show up on an assessment. So again, you're never going to be asked, what skill category is this question asking you? That's not the way to use this. What you want to do is you want to look at this and say, okay, for skill category 1C, which is pretty definitional, we want to be able to identify an economic concept, principle, or model using quantitative data or calculations. Given specific macroeconomic data, can we calculate GDP? Given labor market statistics, can we determine the unemployment rate or the labor force participation rate? Given nominal and real and the nominal GDP and the GDP deflator, can we calculate real GDP? Or given any of the two of those, can we calculate the third? So these are examples. This is not an exhaustive list, and you might not see every one of these on the AP exam, but these are the types of questions that are assessing your ability to identify an economic concept, principle, or model using calculations. In skill category 2, we have 2C, which is interpret a specific economic outcome using quantitative data or calculations. And here's another list. It's again, the kind of thing that you might be asked. You probably won't be asked all of them, but you may be asked one of these or something very similar to it. So we're given some information and we have to interpret that information. That's what skill category 2C questions are asking us. And then skill category 3, that's the can we predict what's going to happen? So for example, given the marginal propensity to consume and a change in taxes or spending, what is going to happen to GDP? Given the marginal propensity to consume and a change in expenditures, what's going to happen to national income? It's another way of asking about that concept. Given some monetary policy action, what will happen to the monetary base or the money supply? So again, not an exhaustive list, but I want you to see the types of questions that get asked in which we need to perform some calculations. Basic definitional, do we know the formula? Given some data, can we make meaning out of it? Given some change, can we predict the effects? That's what we're going to be focusing on tonight. So we're going to warm up with a couple of questions. So again, when you see that pause video, pause the video and go ahead and try to answer it. I'll give you a second to do that. How did you do? Do you see what this question is asking you to do? You have to recognize which of these expenditure categories is included in the calculation of GDP, and then you have to perform that calculation. So this is a pencil and paper test. You'll have a table like this. You can cross out the things that don't count and you can do your arithmetic right on your test. So what you probably did was you crossed off those things that are not counted as GDP, which include taxes, and then you're going to sum the rest. So consumer spending plus gross private domestic investment plus exports plus government purchases, that's all counts and gets added. Imports counted but subtracted. So we subtract that last $100 billion and that gives us our final value. $220 billion is the answer. Here's another question with a calculation. Go ahead and pause your video. So how did you do with this one? Is this the formula that you used? Remember that real GDP is equal to nominal GDP divided by the price index. Usually we're working with the GDP deflator, but it might say price index, it might say aggregate price level, it might say GDP deflator. The GDP deflator is an aggregate price index. If we do this formula, then we can deflate both of our nominal GDP figures. So when you're deflating, you're making something smaller, right? So usually nominal GDP increases and we need to deflate nominal GDP in order to find real GDP. That should help us remember we're doing some division here. So when we do that, when we plug in our numbers and we solve our formula, we see that real GDP in 2012 was 50,000, real GDP in 2013 was 50,000. That means real GDP did not change. Now, I want to tell you something about that real GDP formula. There are 3 different algebraic formulations of this that we want to be able to use. We want to be able to solve for real GDP, solve for nominal GDP, or solve for the price index. So we can memorize all 3 different versions of the formula, or we can use one version, learn one version really, really well, and then think about the algebra that we would need to do to be able to, solve for whichever variable we're looking for. The other thing I wanted you to see in this question is there's more than one way to skin a cat, right? So we're looking at this question. Very often I race to use my formula, I race to plug in my numbers, and then I look at the answer choices and I realize I didn't need to do any arithmetic at all. I just needed to think about it. So read the question carefully, think about what it's asking, and then determine whether or not you can use your reasoning skills to derive the correct answer. So I'm bringing up our rate of change formula. This is a super important one. You definitely have to know this. So rate of change for anything is new minus old over old times 100. What's our new value? What's our old value? What's the difference between the two? And what percentage of the old value are we looking at? In this case, the difference between the 2 nominal GDPs is 10,000. 10,000 is 10% of 100,000. That means nominal GDP increased by 10%. The difference between our 2 price indices is 20. 20 is 10% of 200. That means our price level increased by 10%. If nominal GDP rose by 10% and all of the increase in nominal GDP is reflected in the increase in the price index, then that means real GDP didn't change. So this is another way to answer this question. We didn't need to use our real GDP formula. We could have, but we didn't need to. So when you're reading a calculation question, make sure you read it carefully. Think about whether or not you can use logic and reasoning or determine which formula you need to use. Here's what it looks like in Skill 3C. This is a multiplier question. Go ahead and pause your video. All right, how did we do here? Here is our formula for all seasons. In fact, I taught it just today. Max change in GDP equals initial change in expenditures times 1/1 minus MPC. The max change in anything is equal to the initial change times the multiplier. If our initial change is in an expenditure category like C, I, G, X, or M imports, then we use our spending multiplier, which is 1/1 minus MPC or 1/MPS. If it's a change in taxes or transfers, then when the policy is implemented, the initial change doesn't get counted as part of GDP, right? Changes in taxes and transfers change the amount of disposable income people have. It is the change in disposable income that then gets subject to the MPC and the MPS. So people are going to save part of a tax increase, or I'm sorry, people are going to save part of a tax decrease or part of a transfer increase, and then they're going to spend the rest of it. And that's what's going to be subject to the multiplier effect. So max change equals initial change times the multiplier. If the initial change is an expenditure, we use 1/MPC. If the initial change is a change in taxes or transfers, we use MPC over MPS. And don't forget, are we looking at a direct relationship or an inverse relationship? CIGX go up, aggregate demand goes up, we use 1/MPS. If imports go up, aggregate demand goes down. So we use negative expenditure, right? We use negative 1/MPS. Taxes and GDP, inverse relationship. Taxes go up, aggregate demand goes down, negative MPC over MPS. If transfers go up, aggregate demand, real GDP go up, we use the direct version of it, MPC over MPS. So plug in your numbers and solve your problem. We get the max change in GDP is equal to the initial change of 2 million times 1/MPC, 1 minus MPC, which is 1 divided by a quarter. 4 quarters go into $1. So it's 2 million times 4. Our max change is 8 million. So that was our warm up. Now, if you found those challenging, that's what you're here for. Don't you worry. This is what we're going to be reviewing in our session for tonight. So let's review these topics. So keep in mind, measurement is the big idea. Let's remember what it is we're trying to measure, and that's going to help us determine which formula we needed to use. So like in that nominal and real GDP problem, we needed to deflate nominal. That means we were doing division. If you want to find nominal, you want to inflate real. If you want to inflate something, you're making it bigger, you're using multiplication. Use what you know about what you're trying to measure to help you determine what formula you need to, what calculation you need to perform. Knowing this, the skill that the question is assessing, again, is going to help you determine which variable you're solving for in the equation. That's going to help you set up the formula correctly. So our 3 calculation skills are, do you know how to measure the thing you're being asked to measure? Given an outcome that has occurred, can you determine what the initial change was? And given a change, can you determine the outcome? So that's what we're going to be focusing on in this session. So I bet you recognize what we've got here. Here is our circular flow model. This is our very first macro topic. It's topic 2.1 in Unit 2. We finish up with our basic economic concepts in Unit 1, and then we hit the ground running, learning about the circular flow. So remember that connection. One person's spending is another person's income, and the circular flow helps us learn that. Remember that money from households flows to firms through the product market. Money from firms flows to households through the factor market. So what that tells us is one person's spending on goods and services in the product market becomes another person's income in the factor market. When they then use that income to spend money, right? That money then becomes somebody else's income. That person saves some of it, spends some of it, becomes more spending in the product market. That's more income for firm. That's more income to the people associated with the production of it. Some of it gets saved, some of it gets spent. Now it gets spent in the product market again. So GDP is the value when we're using the expenditures approach of all of the spending that's being done in the market for goods and services. And so it's the sum of spending on by consumers, spending by firms, spending by the government, spending by uh, foreign purchasers of domestic goods and services minus domestic purchases of foreign goods and services. When we calculate GDP using the expenditures approach, we're doing C plus I plus G plus XN. When we're calculating GDP using the income approach, we want to remember that this is the sum of aggregate income. It's all of the income earned by all of the factors of production in the factor market. And so those factor income categories are wages, rent, interest, and profit. Each factor of production has its own name for factor income. Labor earns wages, land earns rent, capital earns interest, and entrepreneurship earns profit. Land, labor, capital, those are entrepreneurship, those are our four resources. Wages, rent, interest, profits, that's our factor income. Always, always, always remember real GDP using the expenditure approach equals real income using the income approach. Let's take a close-up look at GDP and think about what we're measuring. When we are using the expenditures approach, what we're measuring is the output of an economy in a given period. When we're using the income approach, we're measuring all of the income earned in an economy in a given period. In topic 2.1, when we're learning about GDP, we learn what's included and what's not when we're calculating GDP. So remember, the definition of GDP helps us remember what we're measuring. It's domestically produced, so it has to be produced in the domestic economy. It has to be a final good or service. And it has to be produced in that given period. So no used goods, no intermediate goods, no transfers like taxes or transfer payments, no black market activity, no non-market activity. So what's counted, we can remember what's counted in GDP by thinking carefully about what we're measuring. All of the spending on domestically produced goods and services in a given period. The limitations, however, are worth noting. And so that's topic 2.2. It doesn't measure the value of household production, and it doesn't tell us anything about how equally income is distributed in a country. So those are a couple of the limitations of GDP as a measure of overall economic prosperity. So later on in Unit 2, we focus on the difference between nominal GDP, which is the market value of output in the year it was produced, and we compare it with real GDP, which is the market value of the output adjusted for inflation by holding the price level constant. So we can calculate nominal GDP in two different ways, depending on the information that we're given. So nominal GDP is the market value of output in the year it was produced, which means we're using prices and quantities from that year. So current year prices times current year quantities. And all that fancy symbol means is we're going to add up the price times the quantity for every good and service that is included in our GDP. We can also, if we're given real GDP in the aggregate price level, we can also determine nominal GDP by using this formula. But it's just an algebraic re-expression of the formula that we had in our warm-up question. So nominal GDP equals real GDP times the aggregate price level over 100. Real GDP is, we want to know what's happening to output. And so we're going to allow the quantities to vary, and we're going to hold the prices constant to the base year. And that's all this formula says. We use our base year prices times our current year quantities. So again, think about what we're measuring. When we're measuring real GDP, we're measuring our current output in some constant year dollars. Or if we're given nominal GDP and a price level like the deflator, then we're looking at nominal GDP divided by the price level divided by 100 to derive our real GDP. Over here on the far left side, I reminded you that GDP per capita is another calculation we want to be able to perform. So when we look at real GDP, that tells us how big an economy is, right? The total value of the output in inflation adjusted dollars. But it doesn't tell us it doesn't tell us about how much output per person an economy is producing. If you have a household earning $10,000, it's got 4 people living in it, that's a much different picture than a household that's also earning $10,000 that has 400 people living in it. And so to analyze the health of an economy using real GDP, that real GDP per person is a more useful figure. So real GDP per capita is simply real GDP divided by per capita, right? Or by the number of people. I think about caps on people's heads. So per cap, how much real GDP is there? The GDP deflator. So here is our algebraic expression of the GDP to solve for the GDP deflator. So these 3 formulas all along the bottom here, they are all the same formula. They are just rewritten using algebra. So you can learn all 3 of them, or you can learn one of them really, really well and use some algebra to figure out which variable you're solving for. So that's a summary of GDP. The second economic indicator in Unit 2 is unemployment. And again, let's focus on what we're measuring. We usually need to be able to do a couple things. We need to be able to determine what portion of a country's working age population is in the labor force. And we do that by determining the labor force participation rate. Also looking to see what portion of the country's labor force is unemployed. So if we don't have the labor force information, we have to calculate that first in order to determine the unemployment rate, because the labor force is part of the unemployment rate calculation. The labor force is simply the number of employed plus unemployed. The labor force participation rate would be the labor force over the working age population. The unemployment rate is the number of unemployed over the number in the labor force, which is rewritten here, since the labor force is equal to employed plus unemployed. We also learned in Unit 2 about frictional versus structural versus cyclical unemployment. So we want to know what constitutes each type of unemployment, and we want to be able to determine the natural rate of unemployment and the actual rate of unemployment. So the natural rate of unemployment is the sum of frictional and structural, and it's often between 4 and 6%. The actual rate of unemployment includes the natural rate plus whatever unemployment may or may not exist due to the business cycle. So we know that if the actual unemployment rate is greater than the natural unemployment rate, we have a recessionary gap. And if actual unemployment is less than the natural rate of unemployment, the economy is experiencing an inflationary gap. So there's a summary of what the unemployment calculations look like and what it is we're measuring. So the last of the 3 major economic indicators that you learn about in Unit 2 is the inflation rate. We can calculate the inflation rate using any price index. We've learned 2 of them in this course. You learn about the GDP deflator. That is a measure of the aggregate price level. It's the price level for all of the goods and services that are counted in GDP. The consumer price index, however, is measuring something different. It's measuring the change in purchasing power of a given income for a typical family living in an urban environment. So since we care what's happening to purchasing power, now we're holding quantity constant and evaluating changes in prices. So if we have to calculate the inflation rate from the very starting position, there are 3 things we have to be able to do. We have to be able to turn the prices and quantities into market basket values. We have to convert the market basket into CPIs, and then we have to be able to calculate the inflation rate using that CPI. So here's our formulas for our market baskets. The market basket in the base year, we're looking at the current year prices and the current year quantities. The market basket in the current year, again, we care about what's happening to prices. So we look at current year prices, but we hold quantities constant and use our base year quantities. So once we have our market basket values, then the next step, and the step you don't want to miss, listen, with basic math numbers, you can calculate the inflation rate using the market basket values. But in the real economy, the market basket has 80,000 goods and services in it. And so if we want to be able to use a meaningful tool to describe what's happening to inflation, to describe what's happening to purchasing power, we convert those market basket values into CPIs. So the CPI in the base year is always 100 because the calculation is market basket in the current year over market basket in the base year times 100. Well, in the base year, the numerator and the denominator are the same thing. 1 times 100 is 100. So this market basket, turn market basket into CPIs, and then use your CPIs and the rate of change formula to calculate the inflation rate. So I've shown you that the inflation rate is the new CPI minus the old CPI over the old CPI times 100. But if we're given GDP deflators and we need to calculate the inflation rate, new GDP deflator minus old GDP deflator over old times 100. Same formula, rate of change. If we needed to calculate the percentage change in nominal income, new income minus old income over old income times 100. Same formula, rate of change. This one you got to know, and you got to know it well. Why do we have to be able to do this? Because knowing what's happening to the inflation rate, knowing what's happening to real income, that knowing what's happening to nominal income, if we can determine whether or not a person's given nominal income is buying more or fewer goods. Remember, inflation erodes the purchasing power of a given income. So the formula to deflate, to find real income is to deflate nominal income. And now instead of dividing by the aggregate price level, we're dividing by the CPI. And if we wanted to inflate real income to get nominal income, we would multiply by the CPI. Same formulas as we saw on the GDP slide, but now we're looking at incomes and the CPI as opposed to GDP and the deflator. So that's it. This is what you need to know in Unit 2, and now we're going to practice it. So again, when you see the pause button, you're going to pause your video and try to solve the problem. So what I did was I highlighted in red and green the numbers in the question that we need to plug into our formula. So since we are being asked for both nominal and real GDP, we want both formulas. So remember, nominal equals real times the price index. So in 2006, we're told that real GDP is 1,000 and the price index is 100. That means nominal GDP is 100. We need real GDP in 2010. And so now we're going to use nominal divided by the price index divided by 100. You can do nominal divided by the price index times 100. I think the arithmetic is easier. I divide the price level by 100 first, and then I divide nominal GDP by it. So in this case, we would be setting up a formula that says 2,200 over 110 divided by 100, which is 2,220 divided by 1.10, that gives us $2,000. So we had to find nominal GDP for 2006, real GDP for 2010. We use both versions of our formula, and we find that B is the right answer. Here's another one. How are you doing? Okay, same formula. Let's bring it back up. Real GDP equals nominal divided by the price index divided by 100. Plug in our values. We're doing 50 billion divided by 200 divided by 100. 50 billion divided by 2. It's that hard AP macro math. That comes up to $25 billion. There's our answer. Okay, this is the formula you want to know, guys, and you want to figure out, what am I looking at? Am I looking for real? Am I looking for nominal? Let's switch to topic 2.3, which is unemployment. Okay, did you get this one right? All right, let's take a look. The unemployment rate, again, is the unemployed over the labor force. Now, we don't have the number of unemployed, but we have the unemployed. We have the employed. So we can do the labor force minus employed to find the number of unemployed workers. So 200,000 minus 175 over 200,000. Again, we're getting rid of some of those zeros. So we're basically looking at 1/8, which is 12.5%. So our unemployment rate is 12.5%. Okay, so here is a question that's asking us about change in purchasing power. All right, how did you approach it? If the nominal wage rate increases from 10 to 12, did you use your rate of change formula to determine that the percentage change in nominal wage is a 20% increase? If the increase in nominal wages is 20% and the price level increase is 10%, that means we can buy roughly 10% more goods and services than we could before. And so the worker's real wage has increased by approximately 10%. So if the percent change in nominal wage is bigger than the percent change in the price level, real income has increased. All right, here's an FRQ that's all over Unit 2. So it's got all of the 3 different calculation skills in it. So pause your video, go through each part of the question, and then when you're ready, unpause the video and we'll look at all the answers. Okay, so our real GDP for Clarendon is 200. Our real GDP per capita is 200 divided by the population. For Salloway, hopefully you got real GDP is 300 and real GDP per capita is 25. Our next question asks about the velocity of money. So the minute you see that velocity, you go, oh, that's MV equals PQ or MV equals PY, where M stands for the money supply, V stands for the velocity of money, and P times Y is nominal GDP, right? It's the price level times real output. So if V is the same for both countries, then the country with the higher nominal GDP is the one that has to have the higher money supply. So that's the answer to our question. We proved it using numbers. When you have to explain something in a calculate point, even if you're not doing a calculation, you want to pull the numbers from the question in order to prove that your assertion is true. So you make your assertion and then you prove it's true using the numbers that you're given in the problem. All right, how'd you do with part C? We had to calculate the inflation rate twice. We had to do it for each country. So we did the deflator in year 2 minus the deflator in year 1 over the deflator in year 1. We get 15% inflation rate for Clarendon, 20% inflation rate for Salloway. Part D says, based on the answer to part C, if the nominal interest rate is the same for both countries in year 2, who's got more inflation? I'm sorry, who's got a higher real interest rate? So the real interest rate equals the nominal interest rate minus the inflation rate. So the lower the inflation rate, the higher the real interest rate. So Clarendon has the lower inflation rate, 15% is less than 20. It's the one with the higher real interest rate. And then let's look at the end. This is a very typical point for kids to be able to explain. We're looking at the who wins and who loses when an economy experiences unanticipated inflation. So we want to remember borrowers benefit, lenders lose. We have to explain in terms of the change in the purchasing power of the payments that are being made. Since the actual inflation rate of 15% was equal to the expected rate of 15%, no one's better or worse off. It means the value of the loan repayments is exactly what both the borrower and the lender expected them to be, and the real interest rate is what both the borrower and the lender expected it to be. And so neither is better off. All right, hopefully you did well. Hopefully you had those formulas handy and you feel confident having the opportunity to practice that. Here's an unemployment FRQ for you. All right, it gave you some time to pause your video and do the question. Let's take a look at the answers. Let's see how you did. I bet you did great. So we start off with some production possibilities, and we have to recognize that we're given an input problem. So input problems are less common, but you still want to be able to do them. What that means is we're holding output constant and we're determining how much input we need in order to get that amount of output. So if it takes country X 1 hour to produce a unit of consumer goods and 2 hours to produce a unit of capital goods, what that means is if they had taken that 1 hour from producing consumer goods to producing capital goods, how many capital goods have they have gotten? And the answer is a half a capital good. So the opportunity cost of one consumer good is a half a capital good. And in country Y, the opportunity cost of one consumer good is a half a capital good. Here is an unemployment question with a PPC in it. Okay, I gave you some time to pause your video. Now let's take a look and see how you did. So we are told that country X takes 1 hour to produce a unit of consumer goods and 2 hours to produce a unit of capital goods. Do you recognize that this is an input problem? We're being told that how much output we can get, and we're varying our inputs. That means we have to read for opportunity cost in a slightly different way. If country X takes 1 hour to produce a unit of consumer goods, how many capital goods could it have produced if it took that 1 hour and put it towards the production of those capital goods? Well, if it takes 2 hours to produce a unit of capital goods, that means the hour it spent producing consumer goods could have been used on capital goods, and we would have gotten half of a unit of capital goods. So in this case, once we solve for the opportunity cost, we see that it is the same. And what that means is neither country has the comparative advantage. Then we go into our unemployment. We're given some unemployment figures. We have to calculate the unemployment rate, which is 10%. And we also have to calculate the labor force participation rate, which in this case is 66.67%. And again, simple math, right? We would reduce that down to 2/3 to get 66.67. We're showing our work. I always include the formula the formula in words and then the formula in numbers. You definitely, at a minimum, when you're solving a calculate point, what you have to be able to do is you have to be able to produce the calculation. This part you don't need unless you want it for yourself. This is the part you have to have. In your calculate point, you must show how you arrived at your answer. See, show your work is underlined. All right, how about part D? Well, this is an interpret question, right? We have to figure out where are we on our PPC. Since there's cyclical employment, it means that our actual unemployment rate is greater than our natural rate. That means we're in a recessionary gap. We draw a correctly labeled PPC. Point inside the curve indicates some of our resources are unemployed. I drew a constant PPC because we're told that the opportunity cost is constant. All right, so now let's transition to economic measurement in Unit 4. So in Unit 4, the topics that kids tend to struggle with the most are questions about the monetary base and the money supply, and questions about bank balance sheets and multiple deposit expansion of the money supply. Mr. Romano is going to take you through the financial sector, bank balance sheets, and money creation and the money supply. We're just going to take a look at the monetary base calculation for today. So remember that the stock of money in an economy is measured using different monetary aggregates. And so one of those monetary aggregates is called the monetary base, and that consists of bank reserves and currency in circulation. When we're measuring the actual money supply, the monetary base in and of itself is not the money supply. The money supply includes currency in circulation, which is part of the monetary base, and checkable bank deposits. So I put checkable bank deposits there. It could be checking accounts. It could be checkable savings accounts. I think about 18 months ago, the Fed changed how it measures monetary aggregates. And so savings was the big part of M2 that is now part of M1. So here's a typical type of question. We've got some different monetary and financial assets in the table, and we're asked to determine the value of the monetary base. So we bring up this graphic organizer. It'll help us remember the monetary base is equal to bank reserves plus currency in circulation. So we can immediately cross out treasury securities, checkable bank deposits, and large time deposits. But what gets tricky here is that cash in bank vaults. So cash in bank vaults, if it's not part of reserves, it's part of currency in circulation. So that is included in the $1,000 worth of cash in circulation. And so the monetary base in this case is 500 plus 1,000. So our answer is 1,500. Let's take a look at another one. So now we have another table we were given M1, the monetary base and currency circulation, and it says, based on the data in the table, what is the value of total reserves held by banks? So we can bring back up our graphic organizer. If we're looking for total reserves and we're given the monetary base and currency, well, we can solve for bank reserves. So the monetary base, again, equals bank reserves plus currency in circulation. Bank reserves equals monetary base minus currency in circulation, since we're solving for bank reserves. And so we plug in our formula and we get $5 million as the answer. So again, think about that. Monetary base is bank reserves and currency in circulation. Currency circulation and checkable bank deposits is the money supply. So hopefully that will help you think about what we're measuring when we're working with monetary aggregates. All right, just a little bit more review. We've got 2 more topics. I'm going to show you a tool for measuring government budget balances and current accounts, and then that will bring us to the end of our review video. Okay, so what we're going to be focusing on is measuring surpluses and deficits. That's something that we have to be able to do in topic 5.4 when it comes to the government budget balance, and it's something we have to be able to do in topic 6.1 in terms of the balance of payments accounts. So I use this tool to help me think about whether or not something is moving towards a deficit or moving towards a surplus. I give myself a number line with 0 in the middle. Everything to the left of 0 is the deficit side. Everything to the right of 0 is the surplus side. So when it comes to the government, remember that a budget is a plan of anticipated income and expenses, and the government budget balance is the difference between what the government takes in revenue and what the government spends. So the money that all of the government takes in is called receipts. Revenue, right? Income, different words for receipts, but the money coming in, right, minus the money that the government spends. And so government spending, when we talk about government spending as the purchase of goods and services, that's the part of government spending that's counted in GDP. But that's not the only thing the government spends money on. The government lays out money when it spends on goods and services, but also when it conducts transfer payments. So all of the money that the government spends is called outlays. All of the money that the government takes in is called receipts or revenue. And so I use this number line. If receipts equal outlays, if R equals O, then the budget balance is 0. The government is said to run a balanced budget. If R is less than O, then we're taking in less than we're spending. And that means we're in a deficit. That means the government is spending more than it's collecting. If R is bigger than O, then we're on the surplus side. So this tool can help you measure the government budget balance. If the government cuts taxes or increases spending and transfers, if R gets smaller and or O gets bigger. So look at that number line. If R gets smaller and O gets bigger, we're moving towards a deficit. If we're already in a deficit, an existing deficit will get bigger. If we're starting with a balanced budget, we're going to move into a deficit. And if we're starting at a surplus, we're going to move towards a deficit. So you have to know, okay, what is my starting point? Am I starting with a balanced budget? Well, expansionary policy then is going to move the budget balance towards a deficit. Am I starting in a surplus? Okay, we're spending down a surplus, moving towards a deficit. That's going to help you because that will determine what you need to do. Very often, fiscal policy is paired with a loanable funds market. Mr. Romano is going to be reviewing that in session 5. And so knowing what's happening to the budget balance can help you determine what's going to be going on in the loanable funds market. Okay, now the reverse is true. If the government conducts contractionary policy, any contractionary policy, if it increases taxes, decreases spending, decreases transfers, if R is getting bigger and O is getting smaller, we're moving towards the surplus side of the account. An existing deficit will move towards a surplus, a balanced budget will become a surplus, and an existing surplus will get larger if the government conducts contractionary policy. So that's a tool to help you measure the government budget balance. Let's take a look at the balance of payments accounts because we want to know what gets recorded as a debit or a credit in order to determine whether or not a transaction is going to move the current account towards a surplus or deficit or the capital and financial account towards a surplus or a deficit. So you can take a screenshot of this, you can pause your video and you can write it down. But this records all of the types of transactions that go into the balance of payments accounts and indicates if they're debits or credits. Debits, money is leaving, moves us towards a deficit. Credits, money's coming in, moves us towards a surplus. Imports and exports, that's the most important part. The balance of payments on trade, right? The balance of payments on goods and services, that's a current account transaction. Net capital flow, that's a capital and financial account. Net capital outflow means the CFA is a deficit. Net capital inflow means the current and financial capital and financial account is in a surplus. So balance of payments, we want to think surpluses and deficits. Let's bring back up that tool. But now we're doing it twice. Any transaction that causes money to flow into a country is a credit to its balance of payment account, and any transaction that causes money to flow out is a debit. As the current account moves towards a deficit, the capital and financial account has to move towards a surplus. If you don't remember why, then go back and watch topic 6.1 in AP Classroom to see why a capital and financial account has to any current account transaction must be offset by a capital and financial account transaction. Why? CA plus CFA has to equal 0. So let's practice questions related to these topics now. And I know you can do it. We are in the home stretch. Okay, pause your video. Okay, so what has to happen for the government to run a budget deficit? Well, it means that it means that spending has to be greater than receipts. Okay, so government spending has to exceed tax revenue. There's our answer right there. You see, this is a basic definitional question on this. Here's another one. Go ahead and pause your video. All right, so bring back your tool. So if the government's starting with a balanced budget and it's moving to a deficit in the short run, it means in our answer, we have to see either R is getting smaller or O is getting bigger. So we're looking for a decrease in revenues or an increase in spending. Okay, so a decrease in which of the following? That means a decrease in income taxes, that's a decrease in our revenue. So do you see how this tool can help us measure, help us think about what the answer is to a question about the government budget balance? Here's how this shows up in an FRQ. I just pulled one prong out of an FRQ on this. So go ahead and pause your video. All right, so when you read that question carefully, it said the government had a balanced budget, increases spending while holding taxes constant. Outlays is getting bigger, revenue's not changing. What's going to be the impact of this policy action on the government's budget balance? I know you got it. I know you figured out that the government budget balance will become a deficit. You don't want to say moving towards a deficit here because if you're at a zero budget balance to begin with, you're going to be in a deficit if spending goes up and revenue doesn't change. All right, here's a topic 6.1 MCQ. Go ahead and pause your video. All right, so in our current account transactions, we're looking for imports or exports. We're looking for direct foreign aid. We're looking for remittance payments. Those are the things that go into our current account. Okay, did you find it? The US sells 500 million of products to a Chinese company. That is exports. That's going into our current account. Here's another question. Okay, read the question carefully. Increased surplus in its balance of trade. Balance of payments is the whole thing. It's the current account plus the capital and financial account. Balance of trade, exports minus imports. So what's going to make the balance of trade go towards a surplus? That's less debits, more credits. That's what declining imports and rising exports is going to get us. You got one more in you, a couple more in you? All right, so here is a very typical balance of payments questions. We've got the value of some international transactions in our hypothetical country of 6 land. What is the balance on Sixland's current account? So we are looking for only those current account transactions, imports, exports, foreign aid, remittance payments. That's what goes in our current account. So let's cross off our foreign investment, purchase of real or financial assets. That's capital and financial account transaction. All right, now we have to know, is it a plus or a minus? Exports are a debit. Exports are a credit. Imports, debit. Direct foreign aid from Sixland to other countries. Is money leaving the country? Yep, it's a debit. Remittance payments to Sixland, money coming into the country, it's a credit. So 500 minus 1,000 minus 500 plus 1,100. What's the total sum of our credits minus the sum of our debits? That gives us our current account balance. So Sixland's current account has a surplus balance of $100. Okay, I know this was a dense one. There was a lot in here. Let's think about what our final takeaway messages are. Economists measure all aspects of the economy. You have learned in this introduction to macroeconomics a small fraction of the types of things that economists measure. And I know that you know now that measurement tends to be associated with calculations. So when the AP macro exam assesses you on your ability to say something about economic measurement, chances are you're going to be doing some calculations. I hope that you have seen through the course of this review session that the better you understand what it is you are measuring, the more likely you will be able to derive the calculation you need. I'm not going to lie and say you don't need to memorize some formulas. You do. But knowing what you're measuring, knowing what it is you're being asked, that is going to help you a ton in determining what you're solving for and what kind of calculation you need to perform. Don't forget, just because you see numbers doesn't mean you have to start calculating right away. Read the question carefully. Make sure that you can get by with just using your reasoning skills as opposed to performing a calculation. It is not a math test. All right, friends. So that wraps us up for our second session on economic measurement. Coming up next, we will take a look at the next big ideas. That's economic models and markets. We are going to be learning what are all of the graphs we need to be able to either draw and interpret or just interpret. We're going to go over all the axes, all the curves. Come back next time. Focus on those graphing skills as we put models and markets together in review session number 3. Thank you so much for being with us tonight. Can't wait to see you in the next review session. You are on your way towards a very successful experience. Keep up the good work. Thank you.